Buenas tardes, bienvenidos una vez más a Casting Este. Hoy hemos cambiado el escenario de nuestro programa aquí a Madrid, al Hotel Miguel Ángel, donde nos encontramos ahora con un invitado de excepción que ha venido para celebrar juntos la reunión anual de socios de Zonavalue, para presentar su libro, también en España traducido al castellano, libro que hemos ayudado a traducir, para estar con nosotros charlando de finanzas y para divertirse pues, con todos los socios de Zonavalue Club. Sí, hoy tengo pues, el placer y el gusto de anunciar que estamos aquí con Tobias Carlisle en Madrid, en el día del evento que tenemos con él, para charlar un rato. No hay cosa que nos apetezca más. Thank you for being here. We are totally happy that you are here with us today in Madrid for this event and for this interview. And I want to ask you for start this interview one thing, that is, how did you start in the financial business? Because you are from Australia,
right?
And you were studying lawyer. So how an Australian lawyer became a financial investor in the United States?
That's a great question. Thank you very much, Lorenzo and Ivan, for inviting me. I've loved Madrid so far, loved Spain, so beautiful. We've had so much fun. I wanted to be an investor. I wanted to be a value investor. I read Security Analysis, which was written by Warren Buffett's mentor, his teacher, Benjamin Graham and David Dodd. And I didn't understand any of it because it's way too hard to understand. But I understood Warren Buffett's letters that he wrote to his investors. And I thought that it sounded like an interesting way to approach an investment in the market. And I started working as a lawyer in 2000, which was right at the very top of the dot-com bubble. And so when the .com bubble burst, there were many of these companies that traded down below the cash that they had raised because people were concerned that they had no business model and they were losing money. And these guys who had been investors in the 80s, who had been corporate raiders, came back and started taking positions in these companies and trying to get them to stop losing money and to pay out the cash. And I thought that's a really interesting way of investing, but that's nothing like what Warren Buffett does, because Warren Buffett likes wonderful companies at fair prices, and these are terrible companies at any price. So I went back and I read Security Analysis again. Chapter 28, 29 talks about the liquidating value, and it talks about the relationship of shareholders to management. And I realized that that was a very similar thing to what I was doing as a lawyer, which was corporate advisory, mergers and acquisitions, capital raising, advising companies on how they do a buyback, how they buy another company. And I thought that that would be a way for me to use my skills as a lawyer and transfer them across to investment. So I thought the next time that there's a big crash and these companies become very cheap and they're available in large numbers, I'll start investing that way. And so in 2007, 8, 9, with the big crash, when they traded down and they became available in large numbers, these very undervalued companies, I stopped practicing law and I started investing in these businesses. And they did very well. But the problem with that style of investment is you can only do it when the market is very low. Yeah. And so you need to find some other way that takes the same philosophy, but you can use it over a full business cycle. And so that's when I realized that these guys, in addition to looking at the balance sheet, what they did is they look at the balance sheet in its totality with the market capitalization. That gives you the enterprise value of the business. Absolutely. Then they're looking for the operating income, the size of the business relative to what you're paying. And so that ratio, I call that the acquirer's multiple. It's enterprise value on EBIT or operating income. It's a very powerful metric for finding undervalued companies. Okay. And so that's my philosophy now, and that's what I do.
Okay.
I have a question here, Toby, because That's the long side of your approach, but actually you are a value investor, but you like long-short investing. So the question is, when you short a company, you look for just the opposite way around, or you use more metrics or more things at a time, all combined, to define a short investment? Because we know that shorting is quite tough. So
it's a great question. And there are not a lot of value investors who short, because value is not enough to short a company. But if you think about what you do on the long side, you're not just buying things that are undervalued. You're trying to buy... I have a different definition of quality to the one that many people use. I don't like return on invested capital because it's very mean reverting, which means that if you see something that's profitable with a high return on invested capital, it's likely that the return on invested capital is going to come down over time, which means the company's getting less
changing the cycle again, you mean?
Into the cycle. You're at the top of the cycle.
Gotcha.
And it might be undervalued because people, or seemingly undervalued because people are expecting it to come down the other side.
Gotcha.
But the short side, it starts with, we're looking for financial distress. We want a lot of debt relative to the business. We want them to be losing money, negative free cash flow. So how do they survive if they have a lot of debt and they have negative free cash flow? What they're doing is they're issuing stock a lot. And the way that you issue stock is you have to be a sort of glamorous type of business. And so if I say to you, lots of debt, negative free cash flow, issuing lots of stock, you probably have a number of companies come to mind immediately because they're very high profile companies. So a company like Tesla, for example, Netflix is like that. The reason that they, those are two very different businesses, I should say. Tesla is not as good a business as Netflix. Netflix is a good business, but Netflix is very overvalued, I think, too. So if you go through that process and you find that financial distress, the balance sheet that's highly levered and issuing stock to stay alive, that's not enough, because many of these companies can keep on doing that year after year after year. So what you want in addition is broken momentum. So what broken momentum tells me, and broken momentum is just the stock is no longer up, the stock started going down. Broken momentum
is happening today or wherever.
There are many. Peloton, Uber, Beyond, Burger, Lyft, Netflix.
So you use several other ratios to make the short part.
Right.
Not only enterprise value to it.
Right. And I think what that declining stock price tells you, when you have all of the other things there as well, you have the debt and you have the negative free cash flow issuing stock, what that says is the market is getting tired of funding the story.
Yeah.
And these companies that rely on funding from the market by issuing equity all the time, that puts them into immediate trouble.
Yeah.
Because now they have to make a decision. If they issue stock, that will depress the price. If they don't issue stock, they'll be in trouble. So it creates a moment of instability, and that's when I put the short on, expecting something to happen. And then
it's more activist way that we want to say that. No?
We're looking. That's the catalyst. We're looking for that moment where something is going to happen, and then some will be right and some will be wrong. But across the portfolio, we hope that it generates alpha, or it should do better than the inverse of the market. So it should go down more than the market.
Exactly. Do you think, two questions about that. Do you think that maybe the market these years, it has been in a bubble similar to the dot-com bubble, but in other way, like Uber, Netflix, and a lot of companies that were Tesla not making money, they were risers of money, but they were growing and growing in the market. So it is similar to the things that we were living in the dot-com bubble.
Very similar.
Yeah. And also the performance of the value versus this kind of bubble is also similar to these moments. And do you think this is a similar situation and then it's a great moment to be short in the market in this kind of companies?
So it's a very analogous market to the late 1990s in the sense that the tech companies are very, very expensive. Mm-hmm. I think that they're better businesses now than they were in the 1990s, because I think that they are, many of them do make money. At an operating level, they are making money. The problem is that many of them have taken the view that in order to succeed, they have to dominate their market. And so they've spent, so Netflix is a good example. In order for Netflix to dominate its market, it feels that it needs to spend more money than it's making at any given time. So they've got $10 billion in debt on their balance sheet, which they've been able to raise, and they've been able to use that to buy shows and movies and things for their... But that money has to be paid back at some stage, or it creates a problem for them. So I think it's a good time to be identifying those kind of companies for shorting, because when the market turns, those ones will be down a lot. In the late 1990s, they could have been down 80 or 90%. The difference between now and the late 1990s is in the late 1990s, value stocks were extremely undervalued relative to their long-run mean. Today, they're about fairly valued to a little bit rich. And that could be a function of interest rates being so low. There might be other influences in there. So the spread is very wide. But where in the late 1990s, the spread was on both sides. Now the spread is, the expensive stocks are very expensive and the cheaper stocks are still...
But they are not so cheap as in the 90s.
I expect that there will be a very large drawdown, a decline, crash at some stage. And it will impact the very expensive stocks the most. And the value stocks will probably come back a little bit, but not nearly as much as the expensive stocks. So I think that now is a very good time to be a value investor, because value has not performed well for the last 5 and 10 years. And this happens in the data. You get 5-year periods, about 6 times since 1950, where value stocks have underperformed the market. Each time, values come back very strongly and had some of its best 1, 3, 5-year periods. And we can talk about, when I think that's going to happen, as we've been discussing.
Yeah, sure. I have a question also that is, it's in regard to this kind of bubble that we were talking about. And do you think, there's a thesis around that says that maybe this bubble gets the support from the passive investing that is now, a lot of money moving towards the passive investing. So how do you think about that kind of thesis?
I think that that's probably what drives the bubble. The nature of passive investing is that it doesn't consider whether something is overvalued or not. And the money always flows to the biggest stocks by definition. The market capitalization weighted indexes, the MSCI, they're all market capitalization weighted. They're the most popular indexes. They absorb the most amount of money. And so they create those distortions where they push the money into the bigger companies and make them increasingly overvalued. And there are some people who think that is now just going to continue on forever. Yeah. That passive flows will always push these companies up. And the undervalued companies down here that we like, those companies won't ever see any flows. The thing is that these cycles have happened before. And I personally think that it's a good thing for active investors to have those distortions, because that's what creates the opportunity for us to invest. And it's that process of the active buying the undervalued stocks that eventually starts pushing them back up again. So it's been 2 years where value has gone down, value hasn't worked very well, but something very significant happened on August 27th. It was the best day for value in 10 years, and it was the worst day for momentum in 10 years. And since then, value has been outperforming. So value beat the market and glamour by a wide margin in September, and then it's done it again in October. And so this is what the turnaround looks like. You start getting months that, and then the flows will come back in, and then I think value has now started working, and I think hopefully we've seen the bottom of the cycle, and the next 3 to 5, 10 years are going to be good for value.
We hope those.
We hope.
Yes, well, in there are these theses that, okay, because of the passive investing or all the flows that are going there, this is creating a lot of opportunities.
Right.
In other way, that is what you're saying. But this is the other people that is saying no, because this is going to continue. The investor has changed, So investors, they are going to go to the ETFs, and these flows, they are going to continue in one way or another, maybe not so big as in United States they are, you know. In Europe, we have less, so maybe this tendency has to grow a little bit more. And of course, this is creating a situation that a lot of active investors, they are doing worse than the index, or they are having problems to defend the active investing. You know? So, do you think that this is going to change? Because what we saw in the market right now is that in one way or another, we don't know why this is changing.
I do. I think that it has changed. I think that we've already seen it. Who knows, really? It's impossible to predict what the market is going to do. But these are the things that you would look for, is that very big change on a given day, very high volatility shift, and then continued success for value in the months afterwards and in the years afterwards. I think that the narrative always follows the performance. So when the time to be saying that passive investing was going to be a problem was 10 years ago. If someone had said it 10 years ago, and then we had seen it, then I would say, well, that's a good argument.
Yeah.
But we've seen the performance, and now the narrative comes in. So they're just describing what has already occurred. Are they right? I don't know. I can see, as an investor, that it's creating opportunities for me. I'm sure every other value investor can find opportunities where they want to invest. They're probably feeling very positive about their own portfolio. They like the look of their portfolio. So I think those are very positive signs. You know, you have to be prepared to underperform for long periods of time as a value investor, because that's what keeps the strategy evergreen. Because people who don't like to underperform can't invest in it. They have to be in the index. If you can't have any tracking error to the index, then you can only invest in the index. But if you can underperform for 1 year or 3 years or 5 years, which sounds like an incredibly long period of time. I've lived through it. It's a hard, long time to live through it. But it's happened before, and when it outperforms, it's like magic.
Yeah, and you have to say something that is quite important. That is, you have to be ready to underperform.
Right.
You have to be ready to keep your ideas and your philosophy keep going. Because this is one thing that is happening always in the market, that the people is looking what is going on, and they want to run
short time,
from here to here to there, to changing, you know, every day. And they create a mess in their brain, in their portfolios.
Right.
After that, it creates, of course, losses in their investments. This happens a lot in Spain. Happens the same with investors
everywhere
in the United States.
Absolutely. You need to believe in the logic of the strategy. You need to believe in the philosophy of value investing. If you believe in it, it's very easy, or it's easier to endure the underperformance. So if you believe that the best way to invest is to buy the most cash flows, buy the most balance sheet value as you possibly can with your dollar, to buy things that are undervalued, that are worth more, and then hold them, and then know that over a 3 to 5 year period, they will perform and do better than, not even necessarily do better than the index. That's not necessarily the reason that you do them. You hope that that is what occurs, but you don't necessarily think that that's what's going to occur when you buy them. If you can understand that, and if you're prepared for the underperformance, then you can sort of paradoxically outperform over the very long run.
I'd like to know also if you can give us some of the picks that you now, in regard to this situation that we are talking about, so to be long, because I know Netflix, for instance, is one of your shorts.
Right.
But some of the picks that you would buy now.
So the thing that I have been, the two sectors I think that are most undervalued at the moment, globally and in the US, are financials and energy. And the reasons for both of those being undervalued are very well known. It's been a tough time for financials 10 years ago, and they've had to recapitalize over the last decade. And so now they're much different businesses now than they were 10 years ago. They're much better businesses, better capitalized, but everybody still thinks about them as if they're dangerous like they were 10 years ago. So they're as cheap as they have ever been. So I like financials, but I like energy companies too, because I think that the oil price is low, and that's very good at separating out the good energy companies, the financially robust energy companies from the financially weak energy companies. So if you look through the financially robust energy companies, there are several that stand out, but my favorite is ConocoPhillips. The ticker's COP.
COP.
So they had been very undervalued. They've got their oil globally averages out at a cost of about $35 a barrel. So anything north of $35 a barrel, and they're making money. So with the oil price at $50, that's pretty low, or the low 50s. They're still making money in that environment. So they're generating a lot of free cash flow, and they're using that free cash flow to buy back stock. So I think that they have the things that I like: a healthy balance sheet, lots of free cash flow, and management that has initiated a very material buyback. And so they'll buy back stock, and they also put their dividend up. The dividend is up 38%, which is a very material increase, and the stock hasn't moved. So we bought the position before the big buyback and dividend announcement was made, and now that it has been made, the stock still hasn't moved much, but so I still think that's very good value. And if anything happens to the oil price, because we know that the oil price cycles, at the moment it's near the bottom of the cycle. If it cycles up, it could be explosive for something like ConocoPhillips.
Yeah, sure.
Yes, because these companies they are not they are undervalued,
Right.
only because the investors they only see the price of the oil,
Exactly.
and they don't see the financial of the companies. So they say the oil is cheap, so
Right.
all the sector isolate,
It's gonna be cheap.
you know, and they don't separate goods from bads
Right.
inside the sector.
Right.
So it's also one thing that is happening in these kind of sectors, you know, that they are too much huge only because of the price of the oil. No?
Right. The focus is on, well, the problem is that people think in terms of macro.
Yeah.
Oil is down, so therefore don't buy these oil stocks. And oil is going like this, and oil will always go like this. But instead what happens is oil goes like this.
Yeah.
And at the moment oil is here, and this company is still making money,
Yeah.
buying back stock,
Even
very
in
healthy,
that,
even here.
exactly.
With oil up here, it's a totally different company.
No,
I think it could be.
always there are different companies doing in the same sector.
Right.
Great.
So
Yeah.
with the oil here, some of them they are going to lose money,
That's right.
and some of them they are going to make money.
Right.
So these is the ones that we have to look for.
So we want the good operators, we want the smart guys, the guys who look after the balance sheet, try to keep their costs down, and then look after shareholders by doing big buybacks when the stock price is depressed.
And you mentioned that you like also the financials, the financial sector, and we know that many studies, over time said that financial is a sector to avoid. And you say that something has changed currently because of the recent past. No, you mean? No? What is the reason that you see to invest in financials now?
They're very well capitalized. So where there have been lots of changes to the regulations around financials around the world, Europe and in the US, and that has resulted in them. They have different leverage ratios to what they used to have, and their composition of their assets is different. So they're better quality balance sheets now than they were in the crash previously. And they've become much more prudent. They've become much more conservative in the way that they manage those businesses. And so even with all of that, they've had to raise money repeatedly, and that has depressed the stock price because people don't like to continue to donate money to the company.
Yeah.
And so now the balance sheets look much healthier. The businesses are run more conservatively, but the stock price is very low because everybody's concerned about what happened 10 years ago. And I think that there's also some issues with interest rates being very low. That makes it hard for financials to make money. Exactly. But that's what we want. We want the industry to be having some cyclical problem that we can see. We know that interest rates won't always be zero or negative. Interest rates will turn around, and the companies that can survive when the times are tough like this are good businesses to be in. And So there's Bank of America is a very good US bank. Wells Fargo is a very good US bank, and I think they're undervalued, very well managed.
Yeah.
In here, I will make a distinction between the American banks that they have made the job to recover and to recapitalize and to change and European banks that in Europe, value investors, we are like, wow, banks,
totally
we don't
scary,
like it a lot, because they are...
We are biased.
Yes, because they have not done anything from the crisis till now. So they are,
In the same position?
yes,
Right.
with a balance sheet full of shit, with a lot of things that they don't want to clean, Because it's difficult that here, government, banks, they are almost the same. So this is like Japan in the 80s.
Right.
After the crash of Japan in the 80s, that they were doing nothing to clean the banks,
Right.
And everything was, down the floor. This is what is happening in Europe. So it's very different
To the US.
to United States. So banks in United States, in my opinion, they are very, very good right now.
Yeah.
In terms of balance sheet, of reorganization of the business,
Right.
but it's not the same in Europe.
Right. Well, I only invest in the US, so I'm focused on US banks, and but there are many value investors who don't like financials, and the problem is that it's still a commodity business. It's tied to interest rates, although some are better than commodity businesses, and you have assets that are very hard to value, very opaque financial statements and difficult. But it's a very large part of the economy.
Sure.
And they are cyclical type businesses, and I don't mind investing in cyclical businesses if I can get them at the bottom of the cycle. So I think that the financial sector is underinvested in the States.
Bueno, pues hasta aquí vamos a dejar aquí la primera parte de este casting strategies que estamos haciendo con Toby aquí en Madrid. En el siguiente vídeo haremos la segunda parte y seguiremos hablando. Lo vamos a hacer en dos partes porque hablar con Toby no tiene final y no queremos cortar aquí el programa. Así que lo dejamos para el siguiente casting strategies. No os olvidéis suscribiros al canal y esperar los siguientes vídeos y compartirlos en las redes sociales si os ha gustado. Gracias y hasta el siguiente vídeo.